Hey Big Bulls, welcome to another episode of Bullseye. Today we talk about what's driving the bank stocks, 3 reasons why Paris defense shares have been surging, and are FIIs coming back to India? Let's start. The market's been climbing at a slow and steady pace in 2025, but banking stocks are where all the action has been. The Nifty Bank Index has surged 8% so far this year, with private banks leading the charge. All this when Nifty is just about 2% during the period. So, what's giving banks this sudden boost? Well, a lot of it comes down to one key player, that is the RBI pulling some big moves. They have been super generous. First up, they slashed the cash reserve ratio, that is the CRR, in December, giving banks more room to lend. But that's just the beginning. Since January 2025, the RBI has injected a massive 7 trillion rupees into the system using a bunch of tools like open market operations, that is the OMO, where the RBI buys government bonds to pump liquidity into the market. Then there is the variable repo rate operations, or the VRR, where the RBI lends to banks at rates that change based on market conditions. But it does not stop there. They also tweak the liquidity coverage ratio, or the LCR, letting banks hold less of their retail deposits in government bonds, which frees up more cash for the banks to lend. This all comes at a crucial time when credit growth is showing signs of slowing down in India, with bank credit growth tipping to just 11% in FY25 according to RBI data. And here's where the magic could happen. The hope is that these RBI moves will lower borrowing costs across the board, giving banks the chance to make more profit by lending at better rates and also easing their higher margins. And of course, it's not just the RBI moves that are doing the heavy lifting. The banks themselves have also been delivering. There have been healthy earnings reports from big players like the ICICI Bank, Axis Bank and HDFC Bank, all beating expectations for the quarter ending March 2025 and showing off better than expected asset quality. And with the overall liquidity situation getting better, experts see lenders with more diverse portfolios benefiting from the most of it. Now, the outlook for banks does look bright, but whether this is just a momentary relief or the beginning of a golden period, that will depend on how the next few quarters for the banks unfold. Now, another stock that has been on fire, especially on Tuesday, was Paris Defense, which skyrocketed 20%. And there's more than one reason behind this surge. First up, the buzz around a potential stock split. The company announced that its board is set to discuss the possibility of a stock split while reviewing the quarterly results for the fourth quarter. This would be Paris Defense's first stock split since it went public in October 2021. Now, to break it down simply, a stock split is when a company breaks its shares into new units. While the price per share drops, it makes the stock easier to buy for more people. Basically, it's a way to reward current shareholders and make the stock more appealing to new investors. Looking at Paris, its stock has jumped from 490 rupees per share when it went public in October 2021 to over 1300 per share now. So it seems like Paris wants to make the shares more affordable after such a price surge. Of course, the real kicker here will be the split ratio and how the company reports its earnings for the fourth quarter ending FY25. Next is the foreign institutional investors, or FIIs, that have been showing increased interest in the stock. Over the past year, foreign investors have significantly boosted their stake, jumping from just 0.13% in FY24 to 4.8% in December 2024 and now sitting at over 5% in FY25. This influx of foreign money combined with healthy financials, a strong order book and positive sector growth has helped the stock deliver an 88% return over the past year. Third is the overall defense rally. The rise in Paris defense shares was also boosted by a wider rally in defense stocks. The rising tension between India and Pakistan is definitely a big factor, following a deadly terrorist attack in tourists in Pahalgam last week. And there are anticipations that the country will be stepping up its defense spending. And on top of that, India's big 63,000 crore deal with France for 26 Rafale marine aircraft is also seen as a major trigger. Now, remember how we started this episode by saying that 2020 has been a slow start for the stock market? Well, one big reason is that foreign investors have been selling off stocks since back in September last year, and that trend has kept going into this year as well. But April has somewhat been a turnaround. This month has been like a breath of fresh air, and maybe the stock market is starting to find its groove again. And global investors are also suddenly showing a little love to Indian stocks. They have been pouring money back, maybe feeling hopeful that a strong homegrown economy will help it ride out the global trade war better than others. And what's behind this sudden optimism, you ask? Well, one reason could be the pause in the US-China trade war. After months of escalating tensions, the US has cooled down significantly. Trump stepped back from some of the harshest trade rhetoric and even held off on plans to fire the Fed chair. This has softened the US dollar, making emerging markets like India more attractive to foreign investors. In fact, in just last 9 sessions of April, FIIs have pumped in over 32,000 crore into Indian stocks. And if you look at the US though, it's been the complete opposite. Global investors have been on a selling spree since March. Their debt ETFs in particular have seen some pretty big outflows. It kind of seems like all that money that left India with global investors worried about things like valuations, the rupee, and the fundamentals, and probably parking that money in the US might be coming back to our country now. In fact, analysts told Bloomberg that India is getting all this attention because it's seen as doing better than other emerging markets thanks to our faster growth with hopes of more rate cuts and falling oil prices, which are going to keep the outlook a bit. But the real question then is whether this renewed interest will be sustained or not. Well, that's it for today, folks. We will see you next week with another cracking episode of Bullseye. But before you go, do not forget to subscribe if you haven't already and hit that bell icon so that you know when the next episode drops.